Good evening, students, for another wonderful evening of our videos. So, tonight we're going to be talking about accounting for receivables. It's chapter 9. It is our final chapter of the quarter. I think that's a yay I'm hearing from all of you. Not quite sure. So tonight we're going to start with accounts receivable. A receivable is an amount due from another party. Yes, I already know you know that, but we're still going to talk about it. This graph shows recent dollar amounts of receivables and their percent of total assets in 4 well-known companies. So you have Abercrombie & Fitch, their accounts receivable is 2%. Fitzger's is 7.5%. Callaway Golf is 16%. And John Deere is 49% of their total assets are made up of accounts receivable. A company must also maintain a separate account for each customer that tracks how much that customer purchases has already paid and still owes. So that's the subsidiary ledgers that we have been working with. Sales on credit. On July 1st, TechCom had a credit sale of $950 to Comp Store and a collection of $720 from RDA Electronics from a prior credit sale. So we know we're going to debit accounts receivable, credit sales to record the sale, and we know we're going to debit cash and credit accounts receivable for the collection of the accounts receivable. We have been going through that for quite a while. We omit the entry to debit cost of sales and credit merchandise inventory, so we are just focusing on the sale and the accounts receivable. So here's those same entries, and then we record them in the accounts receivable ledger and in the general ledger in the control account, and we have a schedule of accounts receivable that we'll generate from our subsidiary ledgers to make sure that we tie out to our general ledger. Again, we have been going through that for the last couple of weeks. But what we haven't went through is credit card sales. There are advantages of allowing customers to use credit cards. Customers' credit is evaluated by the credit card issuer, not by the company, which is a huge deal. You don't want to sit there and have to go through every single client's background to find out if they are worthy of credit or not. If you allow your customers to use credit cards, the credit card company already did that for you. Sales increase by providing purchase options to the customer. More customers will be able to purchase items because a lot of people don't have cash nowadays. I know some of you do, but a lot of people don't have cash, and it gives them a better option. I know I use my debit card all the time just so I don't have to write a check. Same kind of deal. If I have that option, I don't have to write out the check. I like that much better than having to write out the check. The risks of extending credit are transferred to the credit card issuer, not to the client. Cash collections are quicker because you get your cash right away. You don't have to wait for the client to actually pay. So the credit card company gives you the cash and the customer pays the credit card. So they get their cash right away. They don't have to wait for it. On July 15th, TechCom has $100 of credit card sales with a 4% fee, and it's $96 cash is received immediately upon deposit. So they're going to debit cash for the $96 that they actually get of cash, debit our credit card expense for the $4 it cost us to get to use those credit cards and get that cash right away, and our sale is still $100. So we have to record that credit card expense right away. Now, what happens if instead TechCom must remit electronically the credit card? So there's two ways the credit card companies can deal with it. They can do it immediately giving the cash, or you have, and that's usually bank cards, and then, or they can remit the cash, like, they need a remittance from you electronically from for the credit card sales receipt for the credit card company, and you have to wait for the $96 cash payment. We will make the first entry on July 15th and the second on July 20th when the cash actually comes in. So on July 15th, we booked to accounts receivable the credit card company of $96, recording the credit card expense of $4 and recording the sale. And then when the cash actually comes into our checking account, we debit cash and credit the accounts receivable, which clears that credit card sale up. So there's just one extra step with a credit card sale, that the credit card company requires a sales receipt. So that'd be like your Visa and your MasterCard and American Express. They typically don't have an immediate deposit of cash. Usually there's a couple days delay. Bank cards, they are immediate. Okay. Installment accounts receivable. Accounts owed by customers for credit sales for which payment is required in periodic amounts over an extended time period. The customer is usually charged interest. Ford Motor Company reports more than $70 billion in installment receivables. So that's your loans. So if you buy a car and you get a loan through the bank or the car company, so Ford, Toyota, whatever, they have an installment agreement with you. So they have it set up on their books as a receivable from you. So every month you have to make a payment on that balance. It's not because they're not a bank, theoretically, but they're loaning money to you. So for Ford Motor Company, they have $70 billion in those accounts or those accounts receivable on the installment basis. So each month they get to credit their accounts receivable for the principal portion of your payment, and they get to record the interest portion as interest income, and then they get to debit their cash for the remaining amount, or for the cash amount that they receive. Valuing accounts receivable. Some customers may not pay their accounts. Sometimes that happens all the time. Especially from 2008 to 2012, there's a lot of people who didn't pay their accounts receivable. They become uncollectible and referred to as bad debts. There are two main methods of accounting for bad debts: the direct write-off method and the allowance method. The direct write-off method is not allowed for GAAP, but it is allowed for tax. The allowance method is allowed for GAAP, but it is not allowed for tax. So you have to make a decision which way you're going to go. And there's usually a book tax difference between the two because of this issue. So the direct write-off method, which is allowed for tax purposes but not for GAAP, TechCom determines on January 23rd that it cannot collect $520 owed to it by its customer J. Kent. So you're going to debit your bad debt expense, the direct write-off, and you're going to credit your accounts receivable for J. Kent, which it's the write-off in your description, and this is going to be in your general ledger, your general journal, and that your description is to write off the uncollectible account. Notice that the specific customer is noted in the transaction so we can make the proper entry in the accounts receivable subsidiary ledger. And you'll be posting it to both the subsidiary ledger and to the control account. How did we just get? There we go. Direct write-off method, recovering a bad debt. On March 11th, J. Kent was able to make full payment to TechCom for the amount he was previously written off. So you wrote it off in the prior year, so now, which prior year was it? Excuse me, it was in a prior month, in January. I'm sorry, didn't mean to yawn. On January 11th, so we're going to have to put it back into accounts receivable to establish their history, so we can see that, we wrote it off, but we put it back in. They reestablished it and they paid it. So we debit our accounts receivable again, and credit our bad debt expense to reinstate the account previously written off. And then we'll also make a second entry to debit the cash and get rid of it out of accounts receivable, J. Kent, to record full payment of the account. Both of those entries are going to go both into the control account and into the subsidiary ledger. Just so you're clear, it's going to hit both of the accounts. Okay? And you do have to do both transactions. You can't just put credit to bad debt expense and debit to cash. You need to reestablish the accounts receivable and then write it off. Okay. Matching versus materiality. The matching or expense recognition principle requires expenses recorded in the same accounting period as the sales they help produce. Materiality states that the amount can be ignored if the effect on the financial statement is unimportant to users' business decisions. The direct write-off method usually does not best match sales with expenses because they can cross periods. So if we had written off that in December, that accounts receivable in December, and then we collected it in March, then they cross periods. See how that works? So we'll have a direct bad debt expense in the prior year, and then now we're going to have a collection of that write-off in the current year. So it isn't matching, but it is immaterial. Okay? The other method is the allowance method of accounting, or allowance method of writing off bad debts. At the end of each period, you need to estimate total bad debts expected to be realized from that period's sales. There are two advantages to the allowance method. It records estimated bad debt expense in a period when the related sales are recorded. So you're doing the matching. So it gets written off in the year of the sale. It records accounts receivable on the balance sheet at an estimated amount at the estimated amount of cash that is expected to be collected. So theoretically, your accounts receivable are properly stated, not overstated, because if you aren't writing them off and you're expecting some of them to be uncollectible, then you're overestimating your accounts receivable. Recording bad debt expense. TechCom has credit sales of $300,000 during the first year of operations. At the end of the first year, $20,000 of credit sales remained uncollected. Based on the experience of the similar businesses, TechCom estimated that $1,500 of its accounts receivable would be uncollectible. So on December 31st, we're going to establish our allowance account, and we're going to debit our bad debt expense. So that's how we get into the expense. And we're going to have another contra asset account called allowance for doubtful accounts, and we're going to credit that for $1,500. So on your balance sheet, you're going to list accounts receivable, and then below that, in a contra account, you're going to list less allowance for doubtful accounts, and you're going to record it as a net amount. So going through the balance sheet presentation, TechCom has credit sales of $300,000. Oh, it's the same example. So for what I told you just a few moments ago, so it's going to be under the current assets. You're going to have your accounts receivable totaled in the total amount that they owe, less the allowance for doubtful accounts, and then you're going to have a net amount. So then that will just be a one-line item. So you don't put it as net, you just show it as a separate listing. Writing off of a bad debt. So once you establish, oh, you know what, I'm getting close to 15 minutes. Before we go here, I'm going to quit this particular video and we'll start up writing off bad debt on the next video.